Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. On today's show, we're talking about your frame of reference. The price of silver has gone up 28% in a little over 2 weeks. We've been saying for a long time that silver is undervalued relative to gold. 2 months ago, gold was trading at 115 times the price of silver. In historic terms, that's a record-breaking ratio. Either gold was overvalued or silver was undervalued. Throughout much of history, the ratio between gold and silver has been hovering around 50 to 1 or 70 to 1, in that range. Sometimes it will go outside that range. For example, in the period from April 2010 to May 2011, the ratio dropped from 65 to 30 before rebounding back to 60 a year later. And that's because the price of silver shot up during that time period at the height of the financial crisis. When silver was trading at such a discount, buying more silver seemed like the obvious thing to do. Markets are truly inefficient, and even markets with a high degree of liquidity and millions of participants, they can get off balance for a period of time. Now, if you've been listening to this podcast for a while, you'll know that I'm not a huge fan of the Wall Street casino. While the price of silver has nearly doubled since March of this year, that may be an illusion. That's because your frame of reference is dollars. Frame of reference is extremely important here. Some people measure their wealth in terms of dollars. Others might choose to measure their wealth in terms of ounces of silver or gold. You see, you might be standing still right now as you're listening to this podcast, or you might be seated at your desk or in your car on the freeway. If you are, you're driving at about 60 miles an hour. But of course, none of those are correct. You're on the edge of the earth that's spinning at about 460 meters per second, or about 1,000 miles an hour. Now, it doesn't feel like you're traveling that fast because of your frame of reference. Now, it turns out that 1,000 miles an hour isn't quite right either. You see, the Earth is spinning around the Sun at a speed of about 30 kilometers a second, or about 67,000 miles an hour. It all depends on your point of reference. Some people choose to keep dollars as their point of reference, but dollars are constantly in motion. They're continually declining in value. Dollars are not money. They're merely currency. In order for something to be considered money, it's got to perform two vital functions. It's got to serve as a means of exchange and as a store of value. And dollars are pretty effective as a means of exchange, but not a very good store of value. See, gold and silver are considered monetary metals. They are money. And many people confuse money with currency because they used to be one and the same. Now, since the middle of March, I've been buying silver every month. Now, silver is mostly used as an industrial metal and to a lesser degree as a precious metal. Both gold and silver are used in small quantities in microelectronics. And with the drop in economic activity caused by the pandemic, it's fair to assume that the increase in the price of silver is not being stimulated by industrial demand. It's the monetary demand for silver that's driving the run-up in prices. Central banks around the world printed trillions upon trillions of dollars, and governments have increased their debt levels even more. In the U.S. alone, the national debt increased by $750 billion just in the month of June. And the Federal Reserve expanded its balance sheet from $4 trillion to $7 trillion since the start of the pandemic. This is not without consequence. Governments are going deeper into debt, and central banks are feverishly printing more money at a time when economies are barely functioning. So there's far more money circulating in an economy that's producing fewer goods, which again doesn't make sense. That's the very definition of inflation. Now, so far we've been successful in exporting our inflation. When you go to Walmart and you buy a pair of shoes that were made in China, or perhaps an electronic gadget, the supplier to Walmart gets paid in US dollars. That supplier has no real use for US dollars, so they go to their local bank, who exchanges the dollars for renminbi. And then China's central bank ends up with a surplus of dollars. So they go in search of assets they can buy with US dollars. Now, for years, they've been buying US Treasury bills. It's the perfect solution. The trade deficit with China results in China buying the surplus debt of the US government. All those extra dollars in circulation get taken out of the economy in the West and end up buying the excess government debt. It's a system that works perfectly until it doesn't. China is increasingly putting their money in hard assets instead of U.S. Treasury bills. When you put dollars in the bank, you're exposed to counterparty risk. And the definition of that is if the bank goes bust, then you don't actually have any money. You merely have a claim on money that's actually the bank's money. that you put on deposit with the bank. When you hold a physical metal in your hand, though, there's no counterparty, and therefore there's no counterparty risk. So back to the frame of reference. My analysis is pretty simple. The more money that central banks print and the more debt the governments take on, the more valuable gold and silver will become. Said another way, the more money that central banks print, the more debt the governments take on, the less valuable currency will be. As you think about that, go out and buy some silver. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.